Hi, Danny speaking.
Afternoon, everybody that's in already. We're waiting a few more minutes just to see who comes in. And just for those, because it's taking a little time to get in, there's quite a number attending today. So just give us another few minutes and we'll start. We'll let you know in the next 5 minutes. Thank you.
Hi, everyone. Sorry we're running a bit late today. Just having a few technical issues with a lot of people struggling to get in. Some of you have already been phoning me, so you know that there have been issues. Just give me a couple more minutes just to make sure everyone can get in. All right, thanks.
Afternoon, everyone. We're just waiting for the last people to get in. Danny did have some technical issues. We've seemed to have resolved those, and people are still coming in. So I think just to be safe, we'll start in 3 minutes' time, which is 10 past. I think that's in order. And stand by. So if you need to make a quick cup of coffee before you start, now's the time. Okay, welcome everybody. It's now time to start. Thank you for attending. Thank you for all your bookings and the support during the year. This is the moment that we wait for each year, Jackie, to give us the update, what SARS has been up to, what's going on with the taxes, and something to plague us in 2022. So going forward, Jackie, I don't want to steal your thunder. The floor is yours.
Great, thanks. Hi, Stan and Danny, and afternoon, everybody. It's great to be here. So yeah, year-end update, looking at all the tax amendments that have come through for this year, and then we'll also be looking at judgments and some SARS documents. So what I'm going to do is go straight into that. So let me share my screen and
Jackie, I don't know if you muted yourself by accident or not. We can't hear you.
in fact, yeah, I'll show you just now as we go through that comment process has resulted in some significant changes between the draft and the final version of the bills. Can you hear me now? And so the final version is what we are dealing with. Most of today's presentation will be focused on the final bill.
Restart your recording maybe there because we missed the intro.
Is it? Okay, let me go back to the beginning. But he said, hang on. Sorry, technical problem. Hold on. Okay, let's try that again. Right. Okay, off we go. Today. So what we're going to be covering is looking at these 2021 amendments, the amending legislation. So these are the final bills that we are looking at. And that's the final taxation laws amendment bill and the Tax Administration Laws Amendment Bill. So these are obviously amendments that are flowing from the budget speech that was presented in February this year. The draft amendments were then released in July, due date for comment end of August, and then it went through quite a vigorous commentary process. And in fact, yeah, I'll show you just now as we go through that comment process has resulted in some significant changes between the draft and the final version of the bills. And so the final version is what we are dealing with now. So most of today's presentation will be focused on the final bills, and then we will also just quickly touch on some recent judgments and then SARS documents and notices. Now, we always take a break, right? So just to tell you that we'll take a break at 2:45. So that's an hour and 10 minutes from now. We'll have a 15-minute break and then carry on from 3 o'clock, and we will be done by 4:30. Okay, so let's go in and have a look at these amendments. So the title of the slide, I've said main amendments proposed, because these are all the proposals that were in the budget speech. Some of these amendments have been withdrawn and some put on the back burner for now. So these are what are proposed, and then I'll pick up and talk about what has come through in the final bill. So you can see there's quite a few different things there. And you will know about some of the controversial issues like the exit tax on retirement fund interest when people cease to be a resident, and also the limitation of the set-off of assessed losses and interest limitations. That's broadening the tax base for companies. And yeah, that's where we see some significant changes coming through between what was proposed in the draft legislation and what's come through in the final legislation. And then we'll go on and talk about these other things as well. So let's start at the beginning, and that's looking at Section 25 dealing with deceased estates. So this is a pretty straightforward amendment, just clarifying the time of disposal of an asset that goes from the deceased estate to an heir. And that's just clarifying that the time of disposal will be the earlier of. Now, this has also changed a bit from what was in the draft, because the draft spoke about simply the time of disposal will be when the liquidation and distribution account becomes final. But in the final bill, they have now changed that slightly based on the comments that were received. And now the time of disposal is going to be the earlier of the actual disposal date or the date on which the liquidation distribution account becomes final. And that will come into operation from the beginning of next tax year, 1st of March 2022. And it also ties in with this definition, a new definition in section 1, definition of liquidation and distribution account, just to clarify what is meant by that. So that's obviously the account that has to be submitted to the master in accordance with section 35 of the Administration of Estates Act. This amendment comes in from the 1st of March 2022. Okay, and that one. So yeah, so those are the two amendments that tie into that. Then we have an amendment dealing with long service awards, and I must say, not quite sure where the call for this amendment came from, but nonetheless, it is quite a welcome amendment because it does create a little bit of relief, additional relief. At the moment, you probably remember paragraph 5 of the 7th schedule, and that talks about acquisition of assets for less than market value, and it has a nil value provision that says there'll be no value on the, basically, we'll put it this way, it says that the value of the asset will be the value minus, in the case of a long service award, 5,000 Rand. So the first 5,000 Rand of an asset that is awarded to an employee in recognition for long service was always tax exempt, as it were, under paragraph 5. But that only contemplated the awarding of an asset to an employee. And so in the explanatory memorandum, and indeed even going back to what was stated in the budget speech, it was stated that it was felt that they needed to broaden this and make it broader than just an asset that was awarded. And so they have also now made it applicable to cash awards, as well as the right of use of an asset, free or cheap services, and of course still the acquisition of an asset for less than market value. So there's these 4 areas where you can look at a long service award, and it can be a combination of those various things. But if you have a combination of these various things, or indeed if you have in one of the 4, it's only the first 5,000 Rand that is free of tax. Now, all these amendments, and there's been amendments to all 4 of these provisions, come into effect on the 1st of March 2022 as well, so from the beginning of next tax year. And when we look at what is actually coming through, we see that paragraph C of the gross income definition is going to be amended. So paragraph C at the moment tells us that any amount received in respect of services rendered comes into gross income, right? That's paragraph C being a special inclusion in gross income. And then we've got various paragraphs to that. And so what is happening here is that they are adding on this additional subparagraph. So subparagraph 7 that's being added onto paragraph C. And so it's paragraph C of the proviso. And it's going to say, sorry, it's paragraph 7 of the proviso to paragraph C. And it's going to say that the provisions of this paragraph, in other words, the inclusion in gross income, shall not apply in respect of any amount received by or accrued to or in favor of any person in respect of long service, as defined in paragraph 5.4 of the 7th schedule, to the extent that the aggregate value of an amount under this paragraph, so if there was any kind of award, plus these paragraphs in the 7th schedule, so the asset, the right of use of an asset, and free and cheap services, so the total value up to 5,000 Rand, if it's in respect of an award for long service, then it will be free of tax. And then we see a similar provision coming through paragraph 5, talking about the award of an asset. So pretty much what was there before, but then it's looking at also combining all of these different provisions. So the total award that is given, the first 5,000 Rand is free of tax. You see that coming through in paragraph 6 as well, and then also paragraph 10. Okay, so it's pretty much the same amendment that comes through in all 4 of those provisions. But of course, it all relates to an award in respect of a long service award. Now, as we saw earlier, as when I was talking about the amendment, in paragraph 5 of the 7th schedule, we have a definition of what is meant by long service. And of course, I think many of you are aware of that. It's been there for a long time. And it just tells us that that has to be an initial unbroken period of at least 15 years, and then thereafter at least 10 years. Okay, so it's that type of long service award that we are referring to. Let's go on to the next amendment. All right, so this amendment, also quite a controversial amendment, and I should have actually highlighted it right up there with the most controversial, but of course, anything to do with Section 7C is always quite controversial. This related to quite sort of complex schemes that SARS and National Treasury had identified, and they therefore were saying that they needed this amendment to expand the scope of Section 7C, which creates the deemed donation when you've got low interest loans to trusts and then also to companies owned by trusts. And then the latest expansion last year was to look at preference shares issued by companies owned by trusts. And then this year they wanted to expand it to also look at where we had a loan advance or credit from a trust to another trust or that is controlled by connected persons. All right, so it was looking at expanding the scope of Section 7C and specifically to address these cross-border transactions that were taking place. But now, in terms of the comment that was received, and it was specifically pointed out to SARS and National Treasury that we need to look at the purpose of Section 7C. And the original purpose of Section 7C was to create this deemed donation to counteract tax avoidance schemes that were using trusts to reduce or avoid estate duty. So the sort of classic situation where you sold assets into a trust on loan account, then the growth in the assets took place in the trusts, whereas you had the loan account sort of fixed in the hands of the founder or the settler, and then that would basically peg the value for estate duty purposes. So Section 7C was really intended to counteract the use of trusts for the avoidance of estate duty. And yet these amendments that they were proposing this year were now going far broader than that and kind of trying to use Section 7C to attack all sorts of transactions entered into making use of trusts. So after a lot of discussion, this amendment has actually been withdrawn. So we're not going to see the amendment coming through, amending Section 7C. So what SARS and National Treasury have said is that they would need to go back to the drawing board and identify what the mischief is that they want to address, and then come up with specific proposals around those particular problems. Then Section 8F, it's not a provision that we often look at, but it's our hybrid instrument rules, hybrid debt. And that's really where you've got an instrument which is set up as debt, but it has features of equity. And these are typically used, and this anti-avoidance provision is typically targeting where people are using these hybrid debt instruments to gain interest deductions, significant interest deductions. And then, of course, the issue is that this is undermining some of the tax base. So we have these anti-avoidance rules in Section 8F. You can see here that they aim to curb the unfair use of hybrid debt instruments and hybrid interest to gain tax benefits. So to ensure that we don't have an undue benefit from an interest deduction, what Section 8F does is it has a definition of a hybrid debt instrument, and if your instrument falls into that definition, then the interest paid by the taxpayer is deemed to be a dividend in specie. All right, so you don't get the tax deduction of the interest. Instead, for tax purposes, you have to treat that as a dividend in specie paid by the issuer of that instrument. And that means that instead of getting the interest deduction, you end up actually having to pay dividends tax in many cases, of course, depending on whether you get one of the exemptions from dividends tax. But Section 8F, and it's had quite a rocky road since its introduction some years ago. And initially, when Section 8F was introduced, this tax treatment in the hands of the issuer, where the issuer effectively loses the interest deduction, there was the equal and opposite effect in the hands of the person receiving the interest. But that fell away with some of the amendments that were made along the line. And so what we ended up with was this kind of one-sided situation where we disallowed the interest in the issuer, treating that as a dividend in specie, so they were then liable for dividends tax, but the person receiving the interest was still taxed on that interest income. And so as a result, the explanation was that the anti-avoidance rule was overreaching because the return would be regarded as interest and also taxable, leading to economic double taxation. And so the proposal in the budget was to make this more equitable, that you had the same treatment on both sides. Now, I mean, quite frankly, if you look at the history of this provision, that is what used to happen. But they haven't gone back to the original legislation. They're just amending this legislation as it stands. And what they're saying is that any amount incurred by a company, that's what it used to read, and now they're saying, or accrues to a person. That part that I've underlined is what they added in respect of interest on or after the date that the instrument becomes a hybrid debt instrument as defined. So that interest is deemed to be a dividend in specie in respect of a share. And so the company paying will be deemed to have paid a dividend in specie and then may have dividends tax. And so it's not going to be deductible because dividends are not deductible. And this is what they're adding in, it's also deemed to be a dividend in specie in the hands of the recipient of that interest. Okay, so they're also treated as receiving a dividend. So what happens is that the person receiving this interest, because it's under a hybrid debt instrument as defined, they in fact will not be taxed as if they're receiving interest. They'll be taxed as if they're receiving a dividend in specie, which in most cases would be then exempt in terms of Section 10(1)(k). Interesting though, so this amendment is then removing this economic double taxation and making this equitable for both parties. So it's a balanced situation. You lose the deduction on one side, but on the other side, they're not going to be taxed on the income. But interesting that this is only going to come into operation on the date that the Taxation Laws Amendment Act is promulgated, and that will be probably December, although often it's in January of the following year. So it might even only be in January 2022. Okay, so that's that amendment over there. And then to carry that through, because we're obviously talking about interest and the recipient of the interest might be a non-resident. And so whereas we are showing that that amount becomes a dividend in specie, and so the non-resident would have received a South African dividend, and they also would be treated as not receiving interest, so there'll be no interest withholding tax. Okay, so that's just to sort of see that through, so that we're treating it for both income tax purposes and the withholding tax on interest. It's treated not as interest, but it's treated as a dividend in specie. That comes into operation from the 1st of January next year. Okay, then this next amendment, which was extremely controversial, creating an exit tax on the retirement benefit of people who are ceasing to be a resident. And so the issue here is that while a person is resident and working in South Africa, contributing to a South African retirement fund, they are getting a tax deduction for their contributions, albeit that it might be limited, but it's a tax deduction under Section 11F. And then when the person ceases to be a resident, of course, they're only going to get the payout from that fund after they have ceased to be a resident. So even if they chose to take the payout, let's say from a preservation fund, we've got that 3-year delay. And it might be that the person chooses only to take their benefit out some years further down the line. So the question is whether South Africa has the ability to tax that benefit when it is paid out to the member. Now, of course, this person is now no longer a resident in South Africa. Well, South Africa, of course, has the ability to tax non-residents on South African source income. And this Section 9(2)(I) provides that these retirement benefits paid from a South African retirement fund will be from a South African source. So that does enable South Africa to tax that benefit even once it's paid out. But there's another factor that one has to consider, and that's whether there's a double tax agreement between South Africa and the other country where this ex-South African is now resident at the time that that retirement benefit is paid out. Because many of these double tax agreements are structured on the basis that when we look at the taxing rights on retirement interests, they often provide that the country of residence has the exclusive taxing right on a retirement benefit. And so if this person is now no longer South African resident, but resident in another country, if the double tax agreement gives the exclusive taxing right to the other country, then of course South Africa loses the ability to tax this benefit. Now we might say, what is the issue with that? But if you think about it, South Africa has granted tax deductions for these contributions. And so by losing out on the ability to tax the benefit when it actually is paid out on withdrawal or retirement, whatever the case might be, in that case, it creates an inequity and, of course, does dilute our tax base somehow. So the the proposal that was put on the table by National Treasury was to create this so-called exit tax, to say that when a person ceases to be a resident, already we have the provision that says that they're deemed to dispose of all of their assets, but that excludes retirement interests. But then the idea was to say, and any retirement interest, there will also be a deemed disposal, and that would create the so-called exit tax on immigration. But this proposed new provision, which would have come through Section 9HC, has in fact been withdrawn. Now, one of the main criticisms around this provision was that this provision would have created a situation of tax treaty override. So South Africa has entered into these tax treaties. South Africa has signed these tax treaties. They are bilateral agreements, each of them between South Africa and the other country. So South Africa has already agreed to those double tax agreements sometimes over the last few decades. And to now suddenly come up with legislation that basically undermines the application of those double tax agreements is not really acceptable in terms of international tax principles. And so one doesn't want to get into a situation of having tax treaty override. It undermines the integrity of the double tax treaty network. And so South Africa has now withdrawn this proposal, and they've said they need to go back to the drawing board and see what they need to do, because the problem still remains that we have the situation of allowing the tax deductions, but then not taxing the retirement benefit, if indeed there's a double tax agreement in place that gives the exclusive taxing rights to the other country. Okay, so that's withdrawn for now. There are also other retirement benefit amendments. There's 3 of them in particular. The one deals with annuities. So we now have compulsory annuitization for most people. It's only people who are over 55 at the time that the change to the preservation fund rules took place. They obviously have had a protection of their vested rights. But for most people retiring in subsequent years, there will be this compulsory annuitization. And certainly with pension funds and retirement annuity funds, all of the members would have this compulsory annuitization, which means you can take a maximum 1/3 of your benefit as a lump sum, and at least 2/3 must be taken in the form of an annuity. Now, this sits in the definition of the various funds. So if we look, for example, at the definition of pension fund, in Section 1 of the Income Tax Act, it tells us that the rules of the pension fund must provide that not more than 1/3 of the total value may be commuted for a single payment, a lump sum, not more than 1/3 is a lump sum, and the remainder must be paid in the form of an annuity. Now, that annuity could be an annuity that is basically provided by the retirement fund, or the retirement fund might purchase an annuity either in the name of the fund or in the name of the member. And then now they've added this, or a combination of annuities. So a combination of what I've just mentioned. So it doesn't have to be simply one kind of annuity. So it does create more flexibility around the types of annuities that might be provided. Linked to this, we also have a new binding general ruling, number 58, which provides rules. It's a binding general ruling, okay? And it provides rules around protecting the integrity of these annuities. Now, notice that this compulsory annuitization doesn't apply where 2/3 of the total value does not exceed 165,000, or the employee is deceased, or they elect to transfer their interest to another fund. Okay, so that's the amendment here, is basically allowing this combination of annuities. Okay, then going back to the other amendments, the second one is allowing a transfer between retirement funds by members who are 55 or older but haven't formally retired. And then the third one looks at the calculation of the fringe benefit, where employers contribute to a defined contribution fund, and where that fund provides risk benefits, so life cover, and basically amending the legislation to enable the fringe benefit to be calculated as simply the amount contributed by the employer. Okay, so it's those 3 amendments coming through on retirement funds. Okay, so just jump past that. Right, then we get to this anti-avoidance provision, and it's an anti-avoidance relating to donations tax, talking about the cession of a right to receive an asset. So what was stated in the budget speech is that schemes have been devised to transfer rights to asset to a trust before any value attaches to the right, thereby avoiding both income tax due to the inclusion of the value of the asset in gross income and donations tax, which would arise on the value of the asset donated to the trust. So the way that these schemes work is that we would have somebody rendering services to somebody else. It could be an employee or an independent contractor. And the person is rendering the service and they are going to be remunerated, if you like, in the form of receiving an asset. But the value of that asset would be, would sort of develop as these services are rendered. So at the outset, before the services have been completed, the asset, there's a right to receive an asset, but there's no value at that point. Once the services have been rendered and we sort of have reached the full fruition of this transaction, then of course there would be a full right, a full value on that asset. But the idea here is that the person cedes that asset to somebody else, and it's typically a trust or a family trust, before they have completed these services and while there's still no value attached in that asset. And so that way there is the sidestepping of donations tax. And so not just donations tax, but then by the time the person has completed the services and they're due to receive this asset, the value of that asset has been ceded. But remember that paragraph C does provide that included in gross income is any amount received in respect of services rendered. And section 7 does also provide that the person rendering the service is the one in whose hands that value will be taxed. But the main issue here really is a donations tax issue, because the point is that at the time that the right to receive that asset is ceded, there's no value attached. So what they have brought about is this new provision, section 57B. So section 57B, obviously that's sitting within the donations tax provisions of the Income Tax Act. And it applies where a person agrees to render services to another person. Now here, they talk about the employee and the employer, but it's for the purposes of this provision. As I said earlier, this can be a true employee or an independent contractor who's rendering services to somebody else. So they just refer to it here as an employee, but it's not necessarily limited to the definition of employee as you would understand it, let's say, for employees' tax purposes. Okay, so it's the person rendering the services to the other person that we call the employer in this situation, where the whole or part of the compensation will be paid in the form of an asset. And prior to the employee becoming entitled to the asset, that person disposes of the right to another person. Okay, so it's contemplating that situation where you dispose of the right to receive the asset before the asset has actually accrued to you. But the point of the matter is that the value of the asset, there is no value in the asset at that stage. So there's no donations tax as it would stand, but that's where section 57B is going to come to the rescue, as it were. So what section 57B does in terms of subparagraph 2 is it tells us to disregard the disposal of the right itself. That in itself has no tax implications, but the employee is treated as having acquired the asset on the date that it would otherwise have accrued apart from the fact that the cession has taken place. And the value is going to be the value that would be included in the person's gross income. So let's say this person starts the contract on the 1st of March next year, and the asset only accrues, the services are completed and the asset accrues, let's say, at the end of May. Now, at the end of May, the asset has a value of, let's call it, R1 million. 1st of March, it had a value of nothing. So what we're saying is that that value that would have accrued had the cession not taken place, that is the value of the asset, and the employee is treated as having disposed of the asset to the other person by way of donation, and the amount of the donation is that amount of R1 million. Okay, it's equal to that expenditure referred to in paragraph A. So we've now got this donation that does have a value, and donations tax will be levied. That R1 million also then becomes the base cost in the hands of the recipient. So the person to whom the asset has been ceded, the family trust, they will be regarded as having acquired the asset for that same amount. All right, so you've got the amount that comes into the gross income, R1 million. You've got the donation of R1 million, and the other person is deemed to have acquired the asset for that amount of R1 million. Okay, so that's the anti-avoidance that comes into effect there, and that will take effect again from the beginning of the next year of assessment, 1st of March 2022. Then there's some amendments, and I'm just going to jump through these fairly quickly. They're sitting in the primary residence exclusion provisions of the 8th schedule, paragraph 48, and it's really just changing the wording there and making it applicable to more people when it talks about the continued use of the residence in paragraph 48. At the moment, it says a natural person or a beneficiary of a special trust must, for the purposes of paragraph 47, be treated as being ordinarily resident for a period up to 2 years if they didn't reside, etc. So instead of just ending with saying or a special trust, it says or a spouse of that person or beneficiary. So that's what's been added in here. So it's just adding in more people into the scope of this provision. Okay. And you'll see that also coming through in paragraph 49, where it talks about non-residential use. Again, instead of just saying that person or a beneficiary of a special trust or a spouse of that natural person or beneficiary. Okay, so they might also be the people who are occupying that residence. Okay, so just making that a bit broader. Right, then we go on to tax incentives, and we all know that section 12J was no deduction after June this year, and I don't need to mention that, but we do see that these incentives, their sunset dates have been extended. So the learnership allowance in section 12H, the sunset date was going to be 31 March 2022, and that's now been pushed out for 2 years. Urban development zones also pushed out for another 2 years. So that's quite good news that those tax incentives will continue to be available. Right, then we go on to another form of incentive, and this is the employment tax incentive, which came about in 2013. And of course, the idea of the employment tax incentive is to provide an incentive to employers to employ young, inexperienced workers, to give them work experience. But some, and of course, being an incentive, people are obviously going to try and come up with schemes that are going to maximize the utilization of the incentive. And these particular schemes that were targeted with this amendment were schemes where there was an employment contract, but the employee was not actually required to work for the employer. The employee actually would use their time studying towards a qualification. So it was building skills, but it wasn't giving work experience. And the point of the employment tax incentive is to give work experience. So they've now amended, or they will be amending, the definitions of employee and monthly remuneration. Monthly remuneration deals with a separate matter, and then also looking at a proviso to section 6, which deals with the qualifying employee. So they've also, in the course of having the draft amendments going through to the final amendments, the consultation process did highlight that the original planned implementation date of these amendments, limiting this definition of employee, it was originally in the budget speech announced that this amendment will come into effect basically from the 1st of March 2021. But of course, we didn't yet have the actual amendments at that stage. So the criticism was that there would be many people who would be legitimately claiming this incentive from the 1st of March 2021 all the way through until we now get this legislation. And to now make this amendment retrospective means that these incentives that have been claimed will now be not legitimate, and it's going to create problems with people having to sort of pay the incentive back, and it just creates all sorts of administrative issues. And so that comment has been taken heed of by National Treasury, and they've agreed to push out the implementation date of these changes so that it's now the 1st of March 2022. Okay, so it'll only take effect from the beginning of next year. So what these amendments will say, when you look at this definition of employee, it previously just referred to a natural person working for another person entitled to receive remuneration. And now it's taking it one step further and saying, and who is documented in the records of the other person as envisaged in the record keeping provisions of the Basic Conditions of Employment Act. So that's anticipating that that would be a normal employee who would have to be working and subject to this Basic Conditions of Employment Act. And then to take it a step further, let me just jump to this one here, the proviso of Section 6, the qualifying employee. This proviso says that if you're talking about a qualifying employee, an employee that would enable the employer to get this incentive, the employee may not, in fulfilling the conditions of the employment contract, be mainly involved in the activity of studying, unless the employer and employee have entered into a learning program, a registered learnership agreement, and in determining the time spent studying in proportion to the total time, the time is based on actual hours. So you've got the employee that has been hired. If they are going to be paid to spend time studying, they can't be spending more than 50% of their time studying. All right, because it says you can't be mainly involved in the activity of studying. Okay, so they can still be doing some studying and some working, but they can't be mainly involved in the activity of studying. So that's the point that's been brought through here. Then the other amendment, just to go back to my previous slide, this definition of monthly remuneration is basically also linking this definition to this Basic Conditions of Employment Act. So it's saying, in determining the remuneration paid or payable, an amount other than a cash payment that is due and payable after having accounted for deductions under Section 34(1)(b) of the Basic Conditions of Employment Act must be disregarded. Okay, so that's the other amendment that's coming through. So those are the amendments to deal with this perceived abuse of the Employment Tax Incentive Act. SARS has released a draft interpretation note dealing with the meaning of employee for the purposes of the Employment Tax Incentive Act. That is currently open for comment until I think it is the first week of December. And so if you do have an interest in this area, it would be worth reading that draft interpretation note to make sure that SARS interpretation aligns with what you believe is the correct interpretation. And if you have comments, then you really should submit those comments through your professional body, certainly by the end of November, so that those comments can be sent through and incorporated into the final interpretation note as to what we mean by employee for the purposes of this incentive. Okay, then on to Section 20. Now I come to this discussion around the tax base for companies, and the statement first made in the 2020 budget speech, picked up again in the 2021 budget speech, around the broadening of the tax base for corporate tax. But then linked to that was the commitment, the stated commitment, that the tax rate would be reduced by at least, let's say 2 percentage points over the next few years. But the reduction of the corporate tax rate could not be achieved in isolation. It would have to be accompanied by this broadening of the tax base for companies. And the broadening of the tax base would come through two particular methods. The one would be the limitation of assessed loss set-offs, not the disallowance, but the limitation. And the other one would be a further limitation of certain interest deductions. Now, we already saw Section 8F, so we see that there are some targeted anti-avoidance provisions dealing with interest. But then we also have a kind of a general interest limitation provision in Section 23M, which I'll talk about just now. So these two measures would be designed to broaden the tax base for companies, and then that would hopefully pave the way for the corporate tax rate to be introduced. So the explanation given by SARS, the reason why they want to limit assessed loss set-offs, they say that over the last few years, there's been an international trend to restrict the use of assessed losses and reduce the corporate income tax rate. To improve the country's competitiveness, they want to, and reduce the appeal of base erosion and profit shifting, encourage investment and promote economic growth. The Minister of Finance announced in the 2020 budget review government's intention to restructure the corporate income tax system over the medium term by broadening the base and reducing the corporate income tax rate in a revenue neutral manner. In other words, to try and still maintain the value and the amount of tax collections from corporate tax. So reducing the tax rate, but broadening the tax base, you would still maintain your same level of tax collections. And therefore, in line with that announcement, government proposed broadening the income tax base by restricting the set-off of assessed losses to 80% of taxable income. So that's what was proposed in the budget. What came through in the draft amendments was indeed this proposal to limit the set-off to 80% of taxable income. That did attract a lot of criticism. There were two main areas of criticism, and to some extent they are interlinked. The one was that this amendment coming in at this time is very unfortunate because many companies are struggling with cash flow. They are struggling with their own business deterioration as opposed to the COVID restrictions, economic lockdown, etc. And so they're already battling, and now to restrict the limitation of the set-off of assessed losses would just make things more difficult for them. That was first part. And then the second part was that that concern would be particularly severe in the case of small business. And so the thinking was, why not have a cap for small businesses up to which the full set-off can apply, and then only assessed losses over and above that stated amount would be subject to the 80% limitation. All right, so that has actually come through in terms of this stated amount. So what they've put in now, let's just have a look at the wording of Section 21A. So currently, Section 21A basically allows the set-off of assessed losses, right, for both companies and individuals. So what they are looking at doing here is that they are looking at splitting Section 21A into two parts. Part one, talking about a company, part two about other taxpayers that are not companies. So other taxpayers that are not companies, there's no change in this wording. This will be as before. So it'll say any balance of assessed loss incurred by that person which has been carried forward. So any assessed loss can be set off if you are not a company. But if it is a company, then the balance of assessed loss incurred in a previous year, carried forward to the current year, will be allowed to be set off that does not exceed the higher of, so not more than the higher of R1 million and 80% of the amount of taxable income determined before taking into account this provision. So for smaller businesses that have assessed losses not exceeding R1 million, they would still be able to set off their full amount of assessed loss without this 80% limitation. But if the assessed loss is above R1 million, then you will be capped at 80% of taxable income. So let's say that you had an assessed loss of R3 million at the end of the previous year of assessment. And this year, in the current year of assessed loss, you have taxable income of R2 million. So in terms of the old rules, you'd be able to set that assessed loss of R3 million off your current year's taxable income of R2 million, leaving a remaining assessed loss of R1 million to be carried forward to the following year. When this amendment comes into play, the current year, you've got taxable income of R2 million times 80%, 1.6 million. So your assessed loss of R3 million, you can only utilize 1.6 million this year, and the other 1.4 million is then carried forward to the following year. And in this current year, with taxable income of R2 million, 20% of that, 400,000, would remain as taxable income, and you'd be taxed on that at 28%. But if, in my example, you had a smaller business where instead of saying assessed loss of 5 million, let's say they only had an assessed loss of 500,000 rand. And in the current year of assessment, they have taxable income of, let's call it 600,000 rand. So they would be able to take current year's taxable income, 600,000, set off the whole amount of the assessed loss brought forward of 500,000 because it's less than $1 million, and they would be left with 100,000 taxable income. Okay, so that is quite a welcome change that they have put this kind of fixed amount in that helps your smaller businesses. And the other significant change that has taken place is that instead of this coming into effect from the next year of assessment, they've actually put this on hold. And they've said that this amendment will actually only come into operation on the date on which the rate of tax in respect to the taxable income of a company is first reduced after announcement by the Minister of Finance in the annual national budget, and will apply in respective years of assessment commencing on or after that date. So this restriction on the set-off of assessed losses, this amendment to Section 21A, will not happen until such time as there's an announcement that the corporate tax rate will reduce. So if the corporate tax rate does not reduce next year, in next year's budget speech, if there's no statement around it, then this amendment won't come into effect, but it's still there. It's been drafted. It'll go through the approval process, but it won't be implemented until we have this announcement about a reduction in the corporate tax rate. Now, it's quite interesting because if we look internationally, this trend of corporate tax rates coming down seems to be reversing. And in fact, we're starting to see corporate tax rates going up in many of our international trading partners. And so it remains to be seen whether, in fact, we do see a reduction in the corporate tax rate. Okay, but if we don't see a reduction in the corporate tax rate, then we won't see this implementation of the amendment to Section 21A. So at least companies will still be able to claim the full set-off of the assessed losses. Of course, linked to this is the limitation of interest. And this limitation of interest deduction, this is the general limitation that we see in Section 23M, which came into effect in January 2015. And it's basically the aim of that provision is to limit excessive interest deductions in respect of debts owed to persons who are not subject to tax in South Africa if the debtor and creditor are in a controlling relationship. Okay, so this is already there in the legislation, but it only applies, this limitation of interest only applies where you've got the recipient of the interest not being taxed on that interest in South Africa, and the debtor and creditor in a controlling relationship. Now, although we've had this provision for a number of years now, government has felt that it doesn't go far enough. And so they had this paper looking at the tax treatment of excessive debt financing, etc. And they reviewed the current interest limitation, also looking at what's being done internationally, debts owed to persons not subject to tax in line with the OECD G20 BEPS Action 4 recommendation. And they felt that this Section 23M does need further amendment. And so these are the amendments that they want to make, is they first of all want to expand the definition of interest that will be subject to this limitation provision, but the limitation will still only apply where the recipient is not taxed on the interest and where there is a controlling relationship. So that's not going to change. It's just that the types of interest will be expanded. The actual limitation will come in at a lower level. So that currently we talk about 40% of adjusted taxable income, which is effectively the tax equivalent of EBITDA, earnings before interest, tax, depreciation, and amortization. So we currently do this calculation looking at this definition of adjusted taxable income, and we multiply that by 40%. But once the amendments come into place, we'll multiply that by 30%. So the limitation will come down. Okay, so there'll be less interest that is allowed as a deduction. They also want to address back-to-back loans in a more comprehensive fashion, and they also want to put provisions in dealing with real estate investment trusts. On the positive side, they do give recognition to the withholding tax on interest. So although we say we're going to have this limitation when interest is paid to somebody who's not being taxed on that interest, we think about that in terms of income tax, but we haven't really recognized the withholding tax on interest that might be paid. And so they will then recognize that as tax that is being paid on the interest. So these are the amendments, and they already have all these draft amendments in place. But again, they've all been put on hold, exactly as we saw with the assessed losses, that these will only come into operation on the date on which the rate of tax is reduced following an announcement by the Minister of Finance in the national budget speech. Okay, so both the assessed loss and the limitation of interest put on hold, and so that will all only come into place if and when the actual corporate tax rate does come down. Right. Okay, let's then the next amendment, also sort of thinking about international tax, so in the corporate tax arena, but specifically international tax. Well, interesting, Section 31 is not only in corporate tax, right? I mean, you can have other persons also affected by Section 31, which is our transfer pricing provision. And Section 31 requires this transfer pricing adjustment. There's a primary adjustment and a secondary adjustment that has to be made And that applies when there is an affected transaction. And an affected transaction is defined in Section 31 as transaction operation scheme, etc., where basically has been entered into between a resident, non-resident, and so on, and those persons are connected persons to one another. You might remember that in 2019, the proposal came through that they wanted to expand this to not only apply to connected persons as defined, but also to take into account associated enterprises. But the criticism there was that we don't really understand what you mean by associated enterprises. We need further clarity, and SARS has indicated that they will provide clarity on the meaning of this term. And until such time as that clarity is provided, this amendment won't come into effect. So initially, the amendment was due to come into effect 1st of January 2022, but this has now been pushed out to the 1st of January 2023. So at the moment, affected transaction means when you've got this transaction between connected persons, okay, not associated enterprises at this stage. Right, then we get on to an interesting amendment dealing with VAT. Now, this particular amendment, it's a next phase in quite a long saga that goes back probably a decade or so. In the 2021 budget statement, the following was said: property developers are entitled to deduct input tax on the VAT costs incurred to build residential property for sale. However, where the developer is unable to sell the residential property and temporarily leases it out until a buyer is found, the developer is required to make an output tax adjustment, that's under Section 18(1) of the VAT Act, based on the open market value of the property when that property is let for the first time. There was an announcement in the 2010 budget review, that's not a typing error, to investigate and determine an equitable value and rate of clawback for developers, as the current treatment is disproportionate to the exempt temporary rental income. But no subsequent changes have been made, and so it's proposed that the VAT Act must be amended to resolve this matter. Now, the thing is that, so currently, and what we had along the way, is that if you look at the normal VAT treatment, so if we have a property developer that is developing residential property, all right, they're planning on selling that property. So they're planning on having a taxable supply when they sell the property. On that basis, they are claiming input tax credits for any taxes paid on the goods or services acquired for the purpose of making that taxable supply. So the input tax has been claimed. But if the developer can't sell the unit, or there's a delay in selling the unit, and in the meantime, they start renting out the unit. So they enter into an agreement for the letting and hiring of a dwelling, which is, to put it in simple English, rental of residential accommodation. That's now resulting in a change of use, because now you are holding the property in order to earn rental. Rental from letting out residential accommodation is an exempt supply under Section 12C of the VAT Act. And so what you're getting now is, what the supply that you're making now is an exempt supply. So there's been a change of use from making a taxable supply to making an exempt supply. And that change of use in terms of Section 18(1) gives rise to this deemed supply, or the output tax that has to be raised by the vendor. And that's based on the market value of the property at the time of the change of use multiplied by the tax fraction. So notice there, that's based on the market value. Now, the person has claimed input tax credits based on their costs along the way. And some of their costs, of course, things like wages and so on, don't carry VAT. But all of the other costs, the acquisition of materials and so on, there's been VAT paid on that, and they've claimed that back as an input tax credit. Now that they start renting out the unit, they've got to take the whole market value of the unit and then take the tax fraction on that, and that becomes output tax, which, of course, if you raise output tax this month, you've got to pay it by the end of the month following the end of the tax period. So it does create a significant cash pressure on these property developers. Well, we did have Section 18(b) that provided temporary relief. It provided a 3-year push out, as it were. So this deemed supply would not apply for 3 years. So you could rent out the property for up to 3 years without having this Section 18(1) adjustment. So it kind of deferred it for 3 years. But that was scrapped from the 1st of January 2018. Okay, so that is gone. So as we stand right now, we just exposed now fully to the Section 18.1 adjustment. Even with Section 18B and with the Section 18.1 adjustment as we have it now, the second concern is how do you treat the subsequent disposal? So you've claimed your input tax, you now have a change of use, you've got to raise the output tax on the change of use, but you still hold the property. What happens when you actually then subsequently sell the property? Well, there's different approaches in terms of how this was treated. Most recently, BGR 55, issued in September 2020, that told us that the subsequent sale of a dwelling, in respect of which the developer was required to have declared the deemed supply under 18.1 or 18B3, so you recognize that output tax, and then you subsequently sell the dwelling, then that subsequent sale is not subject to VAT. Okay, so transfer duty will apply. So that's quite interesting. So as it stands right now, the subsequent sale is not subject to VAT. But not an ideal situation. So having looked at this, interesting that SARS and National Treasury did not go back to Section 18B. That doesn't work for them. They've introduced a new Section 18D. All right, so it should just say new Section 18D. And that says that where a fixed property consisting of a dwelling and such property is developed by a vendor who is a property developer, wholly for the purpose of making taxable supplies or held for that purpose, and that dwelling is subsequently temporarily applied by the vendor. So it's temporarily applied, it's rented out under an agreement for the letting or hiring thereof. So that produces an exempt supply, as I say, under Section 12C, but it's a temporary change of use. If it's a permanent change of use, then there's no question that Section 18.1 will apply. But this is talking about where there's a temporary change of use. It's temporarily applied to be rented out as an exempt supply. In that case, the property is deemed to have been supplied by the vendor. So similar to what we saw in 18.1, there's a deemed supply, but the consideration in this case is not the full market value of the property. It's what we call the adjusted cost to the vendor. And that concept, adjusted cost, is defined. It's already defined in Section 1 of the VAT Act. And this is what it means. Adjusted cost means the cost of any goods or services where tax has been charged or would have been charged if Section 7 had been applicable in respect of the supply of goods or services, or if the vendor was or would have been entitled to an input tax deduction. So our adjusted cost is basically all of those costs on which the vendor claimed the input tax credit. So the goods or services acquired on which tax was paid, acquired for the purpose of making the taxable supply, we claimed the input tax. That total adjusted cost is now your consideration on this change of use, but it's a temporary change of use, okay? So in the tax period in which this change of use happens, and the time of supply, we are told in terms of a new Section 913, is the tax period in which the agreement for the letting and hiring of the accommodation in the dwelling comes into effect. Okay, so the date in which the agreement comes into effect is the time of supply. So the vendor then has to raise output tax based on this adjusted cost multiplied by the tax fraction. Okay, so there will still be an output tax, but it'll be based on this lower amount of the adjusted cost instead of the market value. Then, of course, there's still the question about what about the subsequent supply? What if the vendor subsequently sells the property? So initially they had this proposal, it would be a deemed supply, and then it was pointed out to them that it's an actual sale. So it's not a deemed supply, it's an actual supply. So if that developer subsequently supplies the property by way of a sale, then that subsequent supply will be an actual supply that will carry consideration using the normal consideration rule set out in Section 10.2. Okay, so that's going to be the full amount of the consideration. So whatever you actually sell the property for, you're going to have to raise output tax on that. But then jump down here, you would then claim an input tax equal to the amount calculated under 1029, which was that adjusted cost. All right, so if you think about it, they claimed the input tax as and when they were incurring the expenses. They had the temporary change of use, and so they raised output tax, which kind of reversed that input tax over here. Then they sell the property, so they've got output tax based on the full consideration, offset by that input tax once again. So it's actually just the difference between the total consideration and the adjusted cost that will carry your output tax. But instead of just having output tax on that margin, which is what they had in the draft legislation, they've now got output tax on the full consideration, and you get the input tax that you can claim as a deduction here again. All right, so that is the outcome of these amendments here. The time of supply, of course, is the normal time of supply rule for fixed property, the earlier of registration in the deeds office or any payment towards the consideration. So the subsequent supply, so no longer what we saw just going back here in BGR 55, where we said that subsequent supply is not subject to VAT. Now we are going back to the previous treatment that we had before that ruling was issued to say the subsequent supply is actually a supply. It'll be made with the normal consideration, raise VAT on that, but offset your input tax. And this is going to come into effect from the 1st of April 2022. All right, so quite an interesting amendment. Hopefully everybody is now happy that this will produce a fair result. Now, of course, we did see some terms that were referred to in this new section 18D. We spoke about a vendor that is a developer. A developer means somebody who is improving fixed property or constructing fixed property consisting of a dwelling. So it's talking about residential property. And then if we look at the question of temporarily applied, what do we mean by that? And here we're talking about the application of the fixed property or portion thereof under an agreement or more than one agreement for the letting and hiring thereof. And the agreement does not exceed a 12-month period. Okay, so we're talking about a lease agreement for up to 12 months. That would be regarded as being temporarily applied. And then there's a proviso that's saying temporarily applied does not include the application of fixed property and supplying accommodation in a dwelling under this agreement for letting or hiring thereof, where any such agreement is for a fixed period exceeding 12 months. Because in that case, if you have a lease agreement that exceeds 12 months, then it's not regarded as being temporarily applied. So Section 18D will not apply, but in that case, the normal provisions of Section 18.1 will apply. All right, and then you've got the property which is deemed to be supplied at the current market value. Whereas when Section 18D applies, the concession that is given is that your consideration is deemed to be the adjusted cost. Okay, so interesting amendments that are coming through there as far as that VAT is concerned. Okay, then we'll start on the tax administration amendments before we move on to take a break. So these are in the Tax Administration Laws Amendment Bill. And there's a number of different amendments here. Some are pretty simple, some are fairly complicated. This one here is quite simple, Section 18A. Now, of course, with Section 18A, this is Section 18A of the Income Tax Act, and we know that Section 18A provides a deduction that can be claimed for donations to a public benefit organization. The deduction limited to 10% of taxable income, but you're only entitled to claim the deduction if you have received a certificate from the public benefit organization. So that PBO has to be approved by SARS to issue a Section 18A certificate. And that 18A certificate has to contain certain information. So as it stands at the moment, this is also the information on the certificate is set out in Section 18A2. And it's the requirement to have the reference number, the name of the PBO, the address of the PBO, the date of receipt of the donation, obviously the amount of the donation, and a certification, a confirmation that the donation will be used exclusively for the objects of the public benefit organization. So that's all contained in subparagraphs 1 through to 6 of 18A2A. And then what they want to do is add in subparagraph 7, which will expand that by saying, and such further information as the commissioner may prescribe by public notice. Okay, so it just gives the commissioner, SARS, the opportunity to add to the list of what has to be shown on that 18A certificate. Right, then we go on to Section 64LA, and this is it's probably something you don't come across too often, especially with regards to dividends in specie, but it talks about the refund of dividends tax. But now, of course, the refund of dividends tax would happen when, in this case, with a dividend in specie, the company paying the dividend has to pay the dividends tax on that dividend in specie. But you would look at the recipient of the dividend in terms of deciding whether that dividend would qualify for a tax exemption. For example, if the recipient of the dividend is another company, another resident company. And then, of course, there's also the issue around whether the dividends tax would be less than 20%. And that would be when you've got a double tax agreement. So the recipient of the dividend is in another country, and there's a double tax agreement that provides for a rate lower than 20%. So there you could have an exemption or a lower rate. But at the time of the payment of the dividend in specie, the company doesn't have the necessary declaration or undertaking from the recipient to say that either the exemption or the lower rate would apply. So they pay dividends tax at the full amount of 20%. Then, of course, they get this declaration that comes in later to say, actually, it should have been exempt or it should have carried a rate of less than 20%. Then, of course, you're looking at getting a refund of the dividends tax. So 64LA is the provision that deals specifically with this. Again, that is the provision in the Income Tax Act that we're dealing with, Section 64LA of the Income Tax Act. And that basically says that SARS will only pay a refund of the dividends tax if the claim is submitted within 3 years. But the corresponding period for the dividend in specie, when we count the 3 years, it says 3 years from the date of payment, the original payment of the tax. But when we look at the similar provision that applies with a cash dividend, we count 3 years from the date of payment of the dividend. Okay, so they want to make these two the same, and so they're simply changing this to say the 3 years will be counted from the date of payment of the dividend, similar to what we have with the counting of the 3 years for the purposes of a cash dividend. Okay, I see that there is a question that has come in here. Let me just have a look. Okay, so tax administration amendments always come into effect on the date of promulgation of the tax administration laws amendment date. Okay, so that's always the case with your administrative amendments, date of promulgation. Right, so the administrative non-compliance penalties, and I think we're all aware of this. We heard a lot from SARS during the course of the year that they would be charging this penalty on the late submission of the EMP 501 returns. And that's a penalty under paragraph 14 of the 4th schedule. It can go up to 10% of the employee's tax that is covered for that particular period. But SARS levies this on the basis of 1% per month that the return is outstanding. So they are already wanting to, they have already in fact started levying this penalty. But the problem is that they want to levy the penalty based on the amount of employees' tax for that period. But if the employer has not yet submitted the EMP 501, they don't know what the amount of employees' tax is. And so they want to amend paragraph 14 to enable them to come up with an estimate. Okay, so where the employee's tax is not known to SARS because the return has not been submitted, they don't want to wait until the return comes in and then charge the penalty retrospectively. They want to be able to raise the penalty timeously, and that means they have to estimate the amount of employees' tax. So to do that, they have to have this amendment to paragraph 14 that enables them to estimate the employees' tax. Of course, the big concern is SARS might estimate the employees' tax and then raise the penalty 1% per month based on their estimate of employees' tax. And then when the employer actually does submit the EMP 501, might turn out that the actual SARS estimate might have been too high. And so they've charged too much penalty. So subparagraph 8 addresses that and says if it turns out that their estimate was too high, the penalty must be adjusted in accordance with the correct amount, and then you've got to backdate that. So that'll be with effect from the date that the original penalty was charged. Okay, so if the penalty was based on this higher amount of the estimate, then SARS must reverse the penalty as and when they are aware that the correct employee's tax was less than that, and therefore the penalty should have been based on that lower amount and therefore would have been less. Okay, and then to be a resident or a company that might have been incorporated during the year, or there's been a change of the company's financial year. So in any of those circumstances where you've got a year of assessment, 6 months or less, or it must be less than 6 months, all right, then you would not have to submit a first provisional return. Right, so now the next item to talk about is this paragraph 17 of the 7th schedule. So 7th schedule, note, 7th schedule talking about fringe benefits. And what they are doing here is they are repealing subparagraph 4 of paragraph 17. Okay, so what happens with paragraph 17 of the 7th schedule is that it requires the employer to determine the value, the taxable value of fringe benefits. And of course, they have to then include that taxable value of fringe benefits in the remuneration of the employee, and that becomes subject to fringe benefits tax, right? Now, subparagraph 4 at the moment provides as follows. It says any employer who fails to comply with the requirements of this paragraph, which is that they have to determine the taxable benefit of the fringe benefits and issue a certificate to that effect. So whatever employer fails to comply with those requirements must pay a penalty equal to 10% of the cash equivalent of the value of the taxable benefit in question. Now, the issue is that we've got that penalty of 10%, but we also have a 10% penalty on the underpayment of employees' tax under the 4th schedule. So this actually results in a double penalty, as it were, at the moment, and that's why they've repealed paragraph 17.4, so that if you do understate the value of fringe benefits, that will result in an underpayment of employees' tax, which will trigger a 10% penalty. There's no need to have another 10% penalty under paragraph 17 of the 7th schedule. Okay, so they're just cutting out the double penalty there. Okay, then estimated assessments. Now this becomes quite a saga. This is now the Tax Administration Act number section 95. And this links back to amendments that were made last year. There were quite substantial amendments made to the estimated assessment provisions in section 95. Specifically, the main amendment was to expand the situations where SARS can raise an estimated assessment. So section 95 says that SARS can make an original, additional, reduced, or jeopardy assessment based on whole or in part on an estimate. And that's why I refer to it as estimated assessment. So SARS can raise an estimated assessment in 3 circumstances. A, if the taxpayer has failed to submit a return. B, if they have submitted a return or relevant material, but it's inaccurate or inadequate. And C is where they have failed to submit relevant material, where SARS has called for such relevant material, and it does say after delivery of more than one request for such material. Okay, so in those 3 circumstances, A, B, and C, is where SARS can raise an estimated assessment. And it says in subparagraph 2 that SARS must raise the estimate based on information readily available. And then just jumping through to subparagraph 5, it talks about objection and appeal. So it tells us in subparagraph 5 that an assessment raised under A or C, okay, which is where you don't submit a return or you don't submit the relevant material, is not subject to objection and appeal until such time as the person actually provides the outstanding return or material, as the case may be. And then if SARS has failed to issue a reduced assessment. So the idea here, SARS raises an estimated assessment because there's no return. Taxpayer then submits a return, and then if the estimated taxable income was too high, the idea is that obviously you want the taxable income to come down. So you want SARS to issue a reduced assessment. That can only happen once you have submitted the outstanding documents. And then only at that stage is it subject to objection appeal if SARS fails to issue the reduced assessment. Okay, so that all comes through section 95 and section 95.5 and section 95.6. So but what that all means is that an assessment issued under 95.1b, or where your information was incorrect or inadequate, that will be subject to objection and appeal under section 104 of the Tax Administration Act. Okay, so far so good. Now what has changed here? So they have now amended subparagraph 5 and 6. So subparagraph 5, as I said, it said before that the assessment, the estimated assessment is not subject to objection or appeal unless the taxpayer submits the outstanding return or information and SARS does not issue a reduced or additional assessment. Now they're going to change that to say the estimated assessment under A or C is only subject to objection or appeal if SARS decides not to make a reduced or additional assessment after the taxpayer has submitted the outstanding return or relevant material. Linking to section 95.6, which says a taxpayer who has had an estimated assessment under paragraph A or C may, within 40 business days from the date of that assessment, notice that 40 business days, they may request SARS to make a reduced assessment by submitting a true and full return or the relevant material. So SARS raises the estimated assessment. Within 40 business days, the taxpayer submits the outstanding tax return or the relevant material, and then SARS should make a reduced assessment. They can request SARS to do so, and then if SARS decides not to make the reduced assessment, then it could be subject to objection and appeal, going back to subparagraph 5. But then subparagraph 7 used to just say a senior SARS official may extend that 40 business day period, but up to the prescription period under section 99. Now they're adding in, if reasonable grounds for an extension are submitted by the taxpayer, then the senior SARS official could extend that 40-day period. Up to the section 99 prescription period, which is 3 or 5 years from the date of the original assessment. Of course, it might be that the taxpayer only submits the outstanding return quite some time after the original or the estimated assessment is raised. So then that you're looking at a period not exceeding that 3-year period, or 40 business days, whichever is the longest, 40 business days from the date that estimated assessment is raised. Okay, so that all links. I'm going to come back to this because this is all becoming quite relevant with the issue around auto assessments and SARS estimated assessments linked to that. They're also inserting a new provision, section 95.8, which is going to say if SARS decides not to make a reduced or additional assessment under section 95.6, the date of the assessment, the estimated assessment raised under paragraph A or C, is the date of the notice of the decision. That's for purposes of paragraph 9, which is the dispute resolution process. So if you're counting the days within which you must submit your objection and so on, you're going to count it from the date that SARS notifies you that they will not be reducing or making an additional assessment under section 95.6. Okay. Now, based on the proposed wording, so SARS has now issued this guidance. Based on the proposed wording here, there's basically 3 options once the taxpayer submits an outstanding relevant material. So option 1, SARS accepts the submission and they make a reduced or additional assessment as requested by the taxpayer. And then everybody's happy, obviously. Option 2 is that after review, SARS doesn't accept some of the submission of the taxpayer, and they make a reduced or additional assessment accordingly. But the taxpayer, of course, is not going to be 100% happy with that. And so they say here that that will be subject to objection and appeal because it replaces the assessment contemplated in paragraph A or C. And then option 3 is that SARS doesn't accept the submission of the outstanding relevant material. So they don't make a reduced or additional assessment. They rely on the assessment based on the estimate, on their estimated assessment. And then this new paragraph 95.8 says from the date that they notify the taxpayer that they will not make a reduced or additional assessment, the taxpayer can then follow the objection and appeal process. Okay, so that's how that is all going to work with the estimated assessments. Of course, you can't do anything with an estimated assessment based on an outstanding return until the outstanding return is actually submitted. Right, so Audrey says SARS have issued a revised assessment. Okay, I think that's probably a good time to take a break. It is 2:30, so taking into account we started a bit later. I think let's take a 15-minute break from here. During the break, I will have a look at any questions that have come through on the chat box. So if there's anything else you want to ask, you can pop your questions in there. I'll have a look at those questions and we start the next session. I'll attempt to answer those questions. And then there will also be space for additional questions at the end. Okay, so let's take a 15-minute break and I'll see you back at 2:45. Right, hi everyone. Hope you all are back and had a bit of a leg stretch and some refreshments. So we are ready to carry on with the next session now. As promised, I'm just going to deal with some of the questions that came through. So let me just see here. Under the Q&A, there was a question from an anonymous attendee. Please talk to the EMP 501 audits that go beyond the 30 business days. Yeah, I don't specifically know what you want me to say about that. I mean, if it's a problem with SARS processes and SARS not sticking to deadlines, then you really need to follow that through the normal complaints mechanism, ultimately going on to the tax ombudsman if necessary, so to deal with it that way. And then Sam has asked, could we have an example of how the assessed losses would work in a company? Okay, so remember that this amendment is not going ahead just yet. It won't go ahead unless the company tax rate comes down. But if it did go ahead, so what they're proposing is, or in the amendments which haven't become effective yet, is that they are saying that the set-off will be limited to R1 million or 80% of taxable income, whichever is the greater. So if you had a company with an assessed loss of, let's say, 800,000 Rand, at the end of year one. And then for year two, that company had taxable income before set-off of the assessed loss of, let's say, 2 million Rand, okay? So because the assessed loss is less than R1 million, you would be able to set off the full amount of the assessed loss, just as you would under the current rules. But if that assessed loss was not 800,000, but was, let's say, 3 million, all right, assessed loss, and in the next year of assessment, you had taxable income of 2 million Rand, you would only be able to set off up to 80% of taxable income. So 2 million times 80%, 1.6 million. So you would still be taxed on the remaining 400,000 Rand taxable income. Of course, if you had an assessed loss to start with, a balance of assessed loss of 3 million, and you're now setting off 1.6, then it leaves you with 1.4 million Rand assessed loss that you would then carry forward to the following year of assessment. Okay. All right, so that's how it would work, but remember, it has been put on hold, so it's not in operation, and it's not going to come into operation until such time as there's an announcement about a reduction in the corporate tax rate. Okay, and then the next question from Sam, if you have a lease agreement for 12 months and renew them every year, that's not going to help you because in this definition, let me just go to my slides and then I'll share my screen. There we go, let's just go. Okay, so in this definition of temporarily applied, let me just, wait, I'm doing something strange here. There we go. Now I've actually lost it. I had it open there so that I could deal with it. Yeah, there we go. Temporarily applied. So you'll see here in this definition of temporarily applied, it talks about an agreement for the letting or hiring thereof. Okay, and it talks about an agreement or more than one agreement with a combined total period not exceeding 12 months. So if it's the same agreement, you know, it's talking about the idea here is that the residential property should not be rented out for more than 12 months. Now, it's interesting because under that temporary respite that we had of the old section 18B, it actually gave you a 3-year respite. This is basically saying if the total letting or hiring does not exceed 12 months, then it would be temporarily applied. Okay, so let me just go back and see if there's anything else that's come through. Okay, so no other Q&A, no other chats. Okay, all right. Good, so then I'm going to go on to the second part, and let me just get my screen here to share with you. And let me just close that. Okay, all right, so what I didn't talk about at the end of the first part, I cut it off because I figured we probably needed a break at that stage, was the review of the voluntary disclosure program. And it was announced in the budget that they might review some aspects of the voluntary disclosure program, but there's no amendments in the legislation that have come through, but they have released a draft guide. And so some of the contentious issues are actually addressed in that draft guide. Okay. And then I'm going to carry on then into the second part, which is actually talking about judgments, judgments that we haven't yet discussed in our mid-year update. and then we'll go on and talk about the SARS documents. Okay, let's go to the next one, and that goes into our 2021 judgments. Now we've had, as you can see on the slide here, 3 High Court judgments. Now there have been more than that in terms of tax judgments, but some of them deal with customs and excise, and others deal with process. And I'm not getting involved with that. I want to deal with issues around tax and VAT that practitioners are actually dealing with. The Medtronic case, which dealt with the remission of interest after having entered into a voluntary disclosure agreement. We did discuss that in the mid-year update. Okay, in terms of the Perry formwork case, this is probably a matter closer to home for many people. And this dealt with the penalty for the late payment of VAT, PAYE. And in this particular case, Perry Formwork, it was during the Christmas break. They submitted the EMP 201 for the month of December. They actually submitted that in December before they closed up business and they all went off on holiday. And they instructed their bank to release payment of the employees tax. It was a large amount of employees tax, 10 million Rand, in excess of 10 million Rand employees tax had to be paid over to SARS. They instructed the bank to make that payment on the 3rd of January. Now, the due date for payment obviously is on the 7th of the following month. In this particular year, the 7th fell on a Sunday. So we then go back to the last business day, which would be Friday the 5th. They actually were playing it safe by instructing their bank to make payment on the 3rd of January. The problem is that when the 3rd of January came around, and it was actually, as it happens, the first day that they were all back in the office after the Christmas break, turned out there was not enough money in the bank account to actually make that payment. So they then scratched around trying to get money together, and in short, they ended up paying late. SARS levied the late payment penalty. So in itself, that process, there's nothing untoward about that. But then they applied for a remittance of the penalty, and the question came down to whether there were grounds for remittance of the penalty. Okay, so this is all summarized on the slide over here. And so we see that this payment in excess of 10 million Rand ended up being made on the Monday, the 8th of January. Because what happened is that the expectation, they had done a detailed cash flow forecast to make sure that there'd be enough money in the bank account on the 3rd of January. But when they arrived back in the office on the 3rd of January, it turned out that some of their substantial debtors that should have made payment at the end of December did not, in fact, make those payments. So they were significantly short of cash. They then went about negotiating an emergency overdraft facility, but they were only able to raise an additional 5 million Rand. That, in addition to the debtors' payments that they had received, left them short of 138,000. And so the bank could not release that payment to SARS until they had sufficient funds. They then went all out, getting the outstanding amounts from the debtors, and then payment was made on the 8th of January. So payment was only made 2 days late, we could say, but we know it doesn't matter how late the payment is made, that 10% penalty is levied. But the question is whether there are grounds for remittance of the penalty. Now, when you look at Section 217 of the Tax Administration Act, the grounds for remittance of a percentage-based penalty levied on late payment is when the following 3 requirements have been met. Either it's a first incidence or it involves an amount of less than 2,000 Rand. First incidence means there must be no similar penalty in the last 36 months. Now, they were able to satisfy this requirement of first incidence because they had a clean sheet as far as their payments to SARS were concerned. They had no previous penalty that had been charged. And so they ticked the box on the basis of first incidence, even though the amount clearly was way more than 2,000 Rand. But it was a first incidence. The next requirement is whether there were reasonable grounds for the non-compliance. I'll come back to that. The third requirement was that the non-compliance must have been remedied. And of course, we can tick that because we saw that they had paid the employees' tax, albeit on Monday, the 8th of January. So it comes back to this question of whether there are reasonable grounds for the non-compliance. Now, reasonable grounds in essence means that there were circumstances beyond the control of the taxpayer that prevented the taxpayer from paying the amount of tax on time. So in the judgment, they do look at this waiver provision of Section 217, and it says it does envisage a mechanism to come to the assistance of an agreed first-time non-complying taxpayer who has also satisfied the other 2 requirements. So in the judgment, they do look at this waiver provision of section 217, and it says it does envisage a mechanism to come to the assistance of an agreed first-time non-complying taxpayer who has also satisfied the other two requirements. So coming back to this issue about whether there were reasonable grounds, SARS argued, first of all, they said this taxpayer, because this involves employees' tax, the employer has a fiduciary duty, basically operating almost as an agent of SARS. They have an additional level of responsibility to pay the tax on time. Now, the court rejected the idea of a fiduciary responsibility. And what they said is that SARS failed to consider the manner which the appellant had adopted in order to address the shortfall of tax. So they didn't just sit and passively wait for the additional money to come in. They really went all out trying to negotiate the additional overdraft, chasing up the debtors, trying to get the additional cash. And they eventually managed to get the additional cash, but of course, by then they ended up making the payment late. But in short, the conclusion was that these were circumstances beyond the control of the taxpayer. And on that basis, they said the appeal must succeed. So the taxpayer there was able to get that penalty waived by SARS. Okay, on the Turvest case, so here we talking about a dealer in foreign exchange that had both taxable and exempt suppliers. I'm going to have to go through these cases quite quickly. So I am sort of hitting the fast forward button here, but it really deals with a situation where you've got these mixed suppliers. So obviously you've got a mixed supply. It means that the vendor can't obviously claim all of the input tax on their goods and services acquired, because some of those goods and services are required for making exempt supplies and some for making taxable supplies. Now, this is a dealer in foreign exchange. Now, the exchange of currency is listed as a financial service in Section 2 of the VAT Act. But when you look at the definition of financial service in Section 2, it then has the proviso at the end, which says provided that the activities, and it lists the exchange of currency, is deemed not to be a financial service to the extent that consideration is payable in the form of a fee, commission, etc., etc. So Turvest, in essence, they had basically taken advice from a VAT consultant who advised them that they should change their basis of apportionment, if you like, between what expenses were incurred in the production of exempt supplies and what in the production of taxable supplies. And they had taken the view that when you look at the branches, all of the supplies made by the branches were made to earn commission, which was a taxable supply, whereas the supply made by their treasury function at head office, that was the kind of a pure exchange of currency, if you like. And so on that basis, they had claimed the VAT on all the expenditure incurred by the branches. So they had approached it on that basis. And this had gone to the tax court, and the tax court had found in favor of Turvest. So that was in this case of ABC versus SARS. It was a 2020 tax court case. And they said that A is making mixed supplies, some taxable, some exempt. And basically the tax court found that on the facts and evidence, the commission is the only payment the customer makes to the branches. And on that basis, all of the input tax related to the branches was allowed to be deducted. But then, as you can see on the heading of this case, SARS took this matter on appeal directly from the tax court through to the Supreme Court of Appeal. The Supreme Court of Appeal came out with a different view. They looked in detail at this section 16 dealing with input tax, the definition of financial service, and this proviso that I read to you just now. And they looked at the history of how these provisions had evolved. But of course, coming to the conclusion that basically the financial service and the exchange of currency would give rise to exempt supplies, except for the carve out of the commission. And so they say in the respondent's attempt to claim the entire VAT charge as deductible must fail. All right, so they basically throwing out the conclusion of the tax court and saying, no, you can't claim all of the expenses linked to the branch. You've got to look at the operation as a whole. And the whole operation is basically making a supply of a financial service, except for the commission, and then just the input tax related to that portion. Now, the general basis of apportionment, of course, is on the basis of turnover, and we'll see this coming through the next case that we're going to look at. So the standard basis of apportionment as far as SARS is concerned is the turnover basis. So you would look at what is the total amount you receive, and then how much of that is received by way of exempt suppliers and how much from taxable suppliers, and then you'd have to apportion your VAT, your input tax accordingly. So that was the finding of the SCA. Now, linking it, it actually links to this next case of Mukuru, also a currency dealer. I don't know if SARS just had a focus on currency dealers, but nonetheless, there's also dealt with the currency dealer. Or this one did money transfer, bureau de change, as well as mobile phone credits, but certainly having mixed supplies, right? And so they were looking at the basis on which they could claim VAT. Now, this was a pretty new operation. They only commenced business on the 1st of February 2014. And as we'll see the facts unfold, they had then applied for a specific ruling to deviate from the SARS standard basis of apportionment to use a different basis of apportionment. So they did accept that they had to apportion the input tax, but it was the basis of apportionment that was at question here. Now, Section 17.1 does consider this question of apportionment, that you could only deduct your input tax in proportion to your taxable suppliers in relation to your total suppliers. And it says here that you must use the ratio determined by the commissioner in accordance with a ruling. And the commissioner uses binding general ruling 61 to make this apportionment. While we are looking at Section 17, let's look at this proviso, which says that the commissioner can approve a ruling to use a different basis of apportionment. That when the commissioner approves this ruling, it has to be approved with prospective date, okay, so going forward, except that in some cases they can approve from a previous date. But if you're going to go back to a retrospective approval, they can't go back beyond the start of the year of assessment in which the vendor submitted the application. All right, so this becomes important in the Mukuru case. So BGR 16, sorry, not 61, I'm getting a bit dyslexic because I'm trying to talk too fast. But BGR 16 gives the standard turnover basis of apportionment, and that's the method, that's the default method that SARS has prescribed. Now, this taxpayer was arguing that that method could not apply to them because it gave rise to an unfair result. Now, and so they applied for a ruling to use a different basis. They applied in February 2017, and SARS approved the ruling to use a different basis using a transaction count basis. But then SARS said, right, we can apply that from the 1st of March 2016. You'll see over here. So SARS was going back to the start of the year of assessment in which the taxpayer had applied for this ruling. They applied on Feb 2017. SARS said we can go back and apply this different basis of apportionment from the 1st of March 2016. Okay, the taxpayer was not happy. They said that actually you can't force us to use BGR 16 for the earlier periods because it produces an unfair result. And so they were taking this matter to court on the basis of saying that basically SARS must use this alternative method from the 1st of March 2014. Okay, so in terms of the judgment, they made this point that Mukuru was relying on what is called a condition in BGR 16, and the condition reads, a vendor may only use this method if it is fair and reasonable. Where the method is not fair and reasonable or inappropriate, the vendor must apply to SARS to use an alternative method. And so this is where Mukuru was arguing, this does not produce a fair and reasonable result. Therefore, we can't apply BGR 16. And so SARS is saying that we can use our alternative basis, but only from the 1st of March 2016. Mukuru is saying we need to use that for the periods prior to that as well. But SARS was arguing that they were precluded from going earlier in terms of that proviso. Now, if you look at the SARS guide for vendors, again, here we're looking at a guide and it comes up in the judgment. They're actually referring to this guide. VAT 404 says the only approved method to apportion VAT for mixed supplies is the turnover-based method, unless, of course, you get specific prior written approval from the commissioner in the form of a private ruling to use a different basis of apportionment. So in the absence of a specific ruling to use a different basis, the standard turnover basis prescribed by BGR 16 is the default method and has to be used by taxpayers. Now, the court looked at that, and bearing in mind this is an SCA case, has confirmed that it's not open to a vendor to basically use their own method of apportionment. They can't just ignore the SARS ruling. So you are bound by the method set out in BGR 16, which is the standard turnover basis, until such time as you get a ruling giving you permission to use an alternative basis. So BGR 16 doesn't provide an opportunity for taxpayers to choose their own basis of apportionment. And this is the important point that is coming out of this case, that you have to use BGR 16 until such time as you get a ruling to the contrary. And in this particular case, SARS could not go back earlier than the 1st of March 2016 because of the proviso that I read to you. Okay, so the conclusion of the tax court was held to be correct when it stated that the standard turnover basis set out in BGR 16 was the only ratio applicable until such time as this other ruling came into effect from the 1st of March 2016. So some important points coming out of that Makuru case: be very careful about the apportionment of input tax. Make sure that the apportionment is done correctly. Remember that when you have mixed supplies and you have goods or services that are required by the vendor in making those mixed supplies, the first thing is to do a direct attribution. So if you can attribute specific expenses towards specific supplies, you would do that. And then to the extent that you have overheads and expenses that can't be directly attributed, then you are looking at this apportionment ratio. And then the rule is that you must use the standard turnover basis as prescribed in BGR 16, unless you have a ruling to the contrary. Okay, so be careful about that and make sure that vendors get these rulings timeously, and be careful also about an end date on the ruling. If that ruling is going to prescribe, you need to get a new ruling. Okay, then let's move on to a very controversial judgment, and this is the judgment in the case of Spur Group. It is a Supreme Court of Appeal judgment, and it is five judges, and they were unanimous in this judgment. So it's interesting that this is an appeal brought by SARS against a High Court judgment. So the High Court found in favor of the taxpayer. But interesting, that was a majority judgment. So there were 2 judges found in favor of the taxpayer. There was 1 dissenting judgment, and SARS then took the matter on appeal, and they ended up being successful with a 5 out of 5 judges going in favor of SARS. So this dealt with the contribution paid to an employee share incentive scheme trust. And Spur Group, don't be confused by the name. Spur Group is actually a subsidiary of the holding company, Spur Holdco. We'll come to this just now on the next slide. And this is the operating company. Now, Spur Group had paid 48 million rand to this trust in December 2004. And they had claimed that 48 million rand as a tax deduction on the basis that it was expenditure incurred in the production of income in the course of carrying on a trade, not of a capital nature. In other words, it met all the requirements of the general deduction formula. The key issue that was the focus of this case is, in fact, was this expenditure incurred in the production of income? Was there a sufficiently close connection between the contribution to the trust and the taxpayer's income producing operations? Now, ordinarily, we would, I'm sure, agree that when you have this kind of contribution to an employee share trust, the contribution by the company, if it is expenditure incurred, in other words, is not an expectation of repayment, so it's not a loan, but if it's expenditure incurred, it would be for the production of income, because the whole purpose of setting up this trust is to provide a share scheme for the employees. That is, of course, providing the opportunity to motivate the employees, to make them more productive, and that will be linked to the production of income. And so it does seem odd, and this is what a lot of people are criticizing on this judgment. Why is it that this expenditure would not be allowed as a deduction? Why is it that the court would come to the conclusion that there was not a sufficiently close connection? Well, it comes back to the specifics in this particular case, and I'll come to those specifics just now. But linked to the finding that there was not a sufficiently close connection, then we have to look at the additional assessments that were raised by SARS. So SARS disallowed this expenditure, raised additional assessments. All of these assessments were raised more than 3 years after the date of the original assessments. And so the second ground of appeal raised by the taxpayer was, what about the prescription provision in Section 99 of the Tax Administration Act? So the background to this, as I say, that this particular taxpayer is a subsidiary, it's an operating entity, a subsidiary of the holding company. And this trust was established by the holding company in November 2004, discretionary trust of which the holding company, and I stress this here, the holding company was the sole capital and income beneficiary. Only 6 years later, in December 2010, was the trust deed amended to enable the participants, the employees, to become income beneficiaries. They could benefit from the dividends received by the trust. But the holding company remained the capital beneficiary. The 48 million rand was paid by the taxpayer to the trust on the 7th of December 2004. The trust used that money to buy preference shares in Newco. So in the intervening period, the trust received dividends on those preference shares, but those dividends would flow, if they flowed at all out of the trust, they would flow to the sole income beneficiary, which was the holding company. And then ultimately the Newco shares were redeemed, and the 48 million came back to the trust, and it stayed in the trust and was still in the trust at the time of the hearing of this case. So Spur claimed a deduction of the 48 million rand based on the general deduction formula, but they did apply Section 23H to say that they're not going to get the benefit immediately. So they spread that deduction over the period from 2005 to 2012 and in equal tranches per year, but then half in the year of 2005, obviously at a June year end. They paid this in December. So they claimed half in that year, the full amount for the next few years, and then half in the 2012 year of assessment. So they spread their deduction. So they did apply Section 23H, but they did claim the deduction. SARS argued that they were not entitled to the deduction because there was not a sufficiently close connection between the expenditure and the income earning operations. And they argued that on the basis that the holding company was the sole capital and income beneficiary of the trust at the time that 48 million rand was paid. Okay, sure, the trust deed was amended later on, but SARS was focusing at the time that the payment was made, that the holding company was the sole beneficiary, that the participants could not benefit in any shape or form at that stage. And so they said that there was no causal link between the expenditure and the income earning operations of the taxpayer, the production of income of the taxpayer. There was only an indirect and insufficient link, and therefore they disallowed the deduction. Now, they didn't disallow the deduction immediately. What happened is that Spur had submitted these tax returns, assessments were raised, and only quite a few years later, SARS came back and did an audit and then disallowed the 48 million and raised the additional assessments. I have mentioned about the 48 million rand still sitting in the trust. So when SARS raised those assessments, of course, as I say, more than 3 years had passed. Now, importantly, in the judgment it states, in terms of the trust deed, only the holding company was the beneficiary, and therefore there was nothing to demonstrate that either the operating company or any of its employees stood to benefit from this 48 million rand contribution that had been made. And that's where that link was lost. And as a result of that, the court came to the conclusion that indeed SARS was correct in disallowing the expenditure. So then it came back to the prescription issue, because all of these additional assessments have been raised in July 2015, way more than 3 years after the dates of all of the original assessments, which I've given you over there. So why is it that SARS was able to raise these assessments more than 3 years later? Of course, if you come back to Section 99 of the Tax Administration Act, there is the 3-year prescription, but that falls away where the SARS assessment was basically incorrect on the basis of fraud, misrepresentation, or non-disclosure of material facts. So the question is, was there fraud, misrepresentation, or non-disclosure of material facts? And then if you go back to the actual tax returns that Spur had submitted from 2005 to 2009, in fact, when you look at the questions on the IT-14, and I'm sure you're all familiar with all of these questions, and I'm sure you're all fully aware of how important it is to answer those questions accurately, one can only assume that whoever submitted these tax returns was under time pressure. And so it seems that they just answered no, 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 no to all the questions. And in particular, they answered no to the question, were any deductions limited under Section 23H? Which just seems unfathomable as to why they would have said no, because they had actually applied Section 23H. They also answered no to the question, did the company make a contribution to a trust? They answered no to the question, was the company party to the formation of a trust? And we saw that again in the 2006 return. And SARS indicated that in all of these income tax returns, the field where Spur applied the Section 23H limitation, that was disclosed under the category other deductible items rather than the correct line item, which would be prepaid expenditure as limited by Section 23H. Now, it's not just a case of pedantics in case of saying, well, does it really matter where you show it? Yes, it does matter where you show it, because as far as SARS risk evaluation of these tax returns is concerned, they are looking at these questions and they are looking at the line items on the tax return to enable them to evaluate the degree of risk on a particular tax return. And so that informs SARS decisions around the audits of these tax returns. So SARS indicated that had they known that there were these high risk items earlier, if there had been proper disclosure that had been made, they would have raised the assessments earlier and they wouldn't have fallen foul of that 3-year delay, that 3-year prescription period. And so at the end of the day, the judgment was that Spur had indeed made false statements in the return, and that it caused SARS to have a delay in the raising of the additional assessments. And the judge stated, I should also add that as a matter of policy, a court would be loath to come to the assistance of a taxpayer that has made improper or untruthful disclosures in a return. Clearly, this would offend the statutory imperative of having to make a full and proper disclosure. So, wow, that has got to be a great big warning to anybody filling in an IT-14 or any kind of tax return to really be very, very careful that they are making full and proper disclosure. And that comes through especially in answering the questions and, of course, making sure that you are disclosing items in the correct places and using the correct line items and so on. And so I really think it's incumbent on anybody who is completing these tax returns to make sure that you carefully read through the SARS guide for that particular year, because we know that their returns and even their treatment changes sometimes from year to year. So you can't rely on what you're doing 5 or 10 years ago. You need to be up to date with SARS requirements around these returns and in terms of the questions that are asked, and think about the questions that are asked. Think about your answers. Don't just answer no. Be very careful, because no could result in basically incorrect disclosure, and that in this case, as you can see in Spur's case, it meant that the 3-year prescription did not apply. All right, so the misrepresentations and non-disclosure by Spur caused the commissioner not to assess Spur correctly within the 3-year period. As a result of that, SARS appeal was upheld and the assessments were confirmed. Ouch. So a huge amount of additional tax having to be paid in by Spur as a result of that. Now, the controversy has been around this question of whether a payment to a shared trust should qualify for a tax deduction. But as I say, I think with this judgment, you have to look very carefully at the specific context and the specific provisions of the trust deed, et cetera, in this particular scenario. You can't draw a generalized conclusion now to say, well, now this means that all contributions to an employee share trust will not qualify for tax deduction. That obviously would be far too much of a generalization, but it does indicate that these deductions are always fact specific, and you have to look at the specific circumstances of the particular taxpayer and think very carefully about whether the requirements of the general deduction formula have actually been met, and then to make proper disclosure in the tax return. Okay, then just to list the interpretation notes, I won't keep you for too much longer. These are just the interpretation notes that SARS has issued during the course of the year, and so you can have a look at those. We did discuss a lot of this during the mid-year update, and of course the one that has come out subsequent to that is this IN 118, dealing with the VAT consequences of points-based loyalty programs. But of course, whenever you're talking about, is there going to be a VAT implication? If you talk about output tax, there has to be consideration or a deemed consideration. If you're talking about input tax, there must be a tax that has been paid before you can claim input tax. So if there's no sort of value within this, then there's not going to be any VAT. But where there is value, for example, if somebody has to pay to belong to a loyalty program, then obviously the person running that loyalty program would have to raise output tax on the fee that they are charging. Whether the person paying that can claim an input tax credit depends on whether they're a vendor and whether they are acquiring those services in the course of making taxable supply. So those fundamental principles will still come through even when you're talking about a loyalty program. So have a look at IN 118 if you are dealing with loyalty programs. And then your binding general rulings, again, we spoke about the Section 72 VAT rulings in the mid-year update. Binding general ruling 57 talks about where you are claiming a notional input tax on the acquisition of second-hand fixed property. You take your consideration multiplied by your tax fraction. And the question is whether that consideration includes the transfer duty that has to be paid. Because obviously buying from a non-vendor, you haven't paid VAT on that acquisition, you've paid transfer duty. And so the question is whether the transfer duty forms part of the consideration. The conclusion is that it does not. Okay, that the transfer duty is paid to SARS for the national revenue collections, and it's not paid as part of the cost of acquiring that property. So it's not part of the consideration. Okay, and then in terms of BGR 58, I alluded to this earlier when I said that there's an amendment to these definitions of pension fund, etc., that allows a broader possibility with regards to annuities, and BGR 58 then just actually replaces the old general practice notes that used to apply to the retirement funds to make sure that these annuities are maintained and that they are protected from creditors. So it just links into that. Okay, and then an important one to take notice of is this public notice that was published on the 29th of October, and it links to the fixed amount penalties charged under Section 210 of the Tax Administration Act. Now, fixed amount penalties, if you have a look at Section 210, it tells us that those penalties are levied for incidents of non-compliance. And it says it's the type of non-compliance that is listed or by the commissioner in a public notice. All right, so it says that a public notice will tell you which incidences of non-compliance are subject to the fixed amount penalty. Now, we've had about 4 or 5 of these public notices being published over the years. The first one to be published actually did deal with personal income tax, and it said that failure by a person to submit an income tax return where there are 2 or more returns outstanding will trigger this fixed amount penalty. So what is changing now is that from the 1st of December, it will actually be when there's just 1 or more outstanding income tax returns. Now, as a phase in, initially that will apply only to the 2021 year of assessment. So the earlier years of assessment, you'll still only get the fixed amount penalty if there's 2 or more returns outstanding. From the 1st of December for the 2021 year of assessment, even if there's only 1 tax return outstanding, the fixed amount penalty can be charged. But then from the 1st of December next year, they're going to apply this 1 or more rule to all the way back to March 2006. Okay, but it does link very closely to the issue that we have right now, and that is that we are currently in filing season, and the deadline for submitting the tax returns is for non-provisional taxpayers 23rd of November. And so a non-provisional taxpayer who fails to submit by the 23rd of November, this is for the 2021 year of assessment, they will be subject to the fixed amount penalty. And certainly from the 1st of December, in terms of this public notice, even if that is the first outstanding tax return, the fixed amount penalty will be charged. Of course, that does also link to the auto assessment situation. And so SARS on this notice on their website have said that if they've issued a notice of an auto assessment and the taxpayer has neither accepted nor edited their tax return by the 23rd of November, then they could be subject to this non-submission penalty, this fixed amount penalty for failing to submit a tax return. Okay, so just be very careful about that, if the person does not respond, SARS raises their estimated assessment. And we spoke about these estimated assessments earlier under Section 95. And that could then also carry with it the late submission penalty, the fixed amount penalty for non-submission. So SARS has issued a notice around this. There's a letter to stakeholders, which is available on their website. You can see the link there. And they've also given an example of the friendly SMSs that are going out reminding people to, as far as the auto assessment is concerned, to either accept the auto assessment or submit your edited tax return by the 23rd of November. And for those who are not getting the auto assessment, they must submit by the 23rd of November. Of course, provisional taxpayers who are submitting by e-filing have until the end of January to submit. Then another important aspect is that SARS has relented on their list of qualifying physical disability expenditure relating to children who go to special needs schools. They had issued an amended list. Well, let me go back one step. They had an original list issued on the 1st of March 2012, and then they amended that from the 1st of March 2020, taking a much more limited view in terms of costs of children going to private special needs schools. Due to the public outcry, they've now backtracked on that, and they've said actually they'll go back to their 2012 list, and they will apply the broader definition of the type of expenditure that is allowed. So have a look on the SARS website. I don't have time to necessarily click through all of these links right now, but what it does mean is that if you have a person that has a child at a special needs school who maybe submitted their 2021 tax return on the basis of the more limited type of expenditure that could be considered, now SARS has gone back to their original list. And so now the person possibly could be able to qualify for more expenditure for the purposes of the Section 6B additional medical credit. SARS has indicated that the person can apply for a request for correction to correct that assessment. And if that request for correction facility is not available, they should make use of the objection process. All right, so you can get your 2021 assessment revised if you have already been assessed for 2021. And then the PAYE on pension annuities, this actually links to an amendment that came through in 2019 to paragraph 2 of the 4th schedule. And it speaks to your pension annuities, whether it's paid by a retirement fund or by an insurance company where the person has purchased an annuity. And it links to this issue that where a person has more than one income stream, the amount of employees' tax withheld on the pension annuities is not going to add up to the total tax liability. So it means the person has to pay in extra on assessment. Now, in terms of this amendment that came through in 2019, which originally was going to be effective March 2021, and then it was pushed out to 1 March 2022. So this amendment is coming in from the 1st of March 2022. It basically leaves it open for SARS to issue an instruction around how the employee's tax will be calculated on these annuities. And this directive from SARS, I'm not sure if you can see it on your screen. I'll attempt to open it here and just move it over. Now it's not picking it up. I'm just going to have to explain it to you. But this notice from SARS basically says that from the 1st of March 2022, SARS will issue instructions to the administrators of the retirement funds or the insurance companies that are paying these annuities, indicating the withholding that has to be applied. And this will be where SARS will then look on their records, pick up where people are getting more than one income stream, and they will then notify the funds of the higher withholding rate. And it will be a higher PAYE withholding rate that will apply. So that is going to come in from the 1st of March 2022. 1st of March 2022. Okay, and then on deceased estates, just to notice that any valuation, whoopsie, that was a bit quick. Any valuation of non-listed shares must be approved by SARS. This is just a copy from the notice on their website. They give a checklist that you need to go through and that you have to submit this valuation to SARS for approval before you can apply that valuation in determining, of course, the dutiable value of the estate. Okay, so just to be aware of that. Okay.
Right, so
let's go to the next one, and that goes into...
let's get rid of that. Okay, so we are now open for some questions, and let me just see in the Q&A, and let's go through here. So Peter has asked, does the 80% limitation apply to persons on capital losses? No, it only applies to assessed losses. It's an amendment to section 20. Okay, and then deadline changed to the 2nd of December. Yes, indeed. So I think it was yesterday, SARS announced, or maybe the day before, that they have extended the deadline from, it was the 23rd of November. It's now been pushed out to the 2nd of December. Okay, and right. Sam asks, is this still applicable to a natural person who's a taxpayer who is not required to submit returns? Ooh, I'm not sure what you're referring to. Is this applicable? I'm not sure what you're referring to there, Sam. Maybe you could just clarify that. No sound, Basil. Hopefully the sound came back. Hopefully you can hear me now. All right. And then Anonymous again has asked, a provisional taxpayer, not on e-filing, I assume you mean, states return is due. Okay, no. So provisional taxpayers, look, remember, a provisional taxpayer is not actually registered as a provisional taxpayer. It's somebody who is regarded as a provisional taxpayer, fits into the definition for that particular year of assessment. So if it's stating the returns due on the 23rd of November, well, the 23rd of November deadline applies to non-provisionals. Provisionals submitting on e-filing obviously have until the end of January. So I'm not sure. Perhaps I'm not sure why it would be showing that. Perhaps they're not considering that the person is a provisional taxpayer. Your best bet might be to make use of the SARS assistance there to get an answer on that one. Okay. I see. Okay, done. So like ticking off a to-do list here. So Sam, yeah, the penalties for fixed amounts of returns outstanding for natural persons. Yeah, so okay, so let's have a look at this. The penalty for non-submission of the tax return, where you're talking about an individual taxpayer. So what we're saying is from the 1st of December, which, and now of course they've extended the deadline from the 23rd of November to the 2nd of December. So anyone who doesn't submit by it would be the 2nd of December for the 2021 year of assessment, even if it is the first year that they have a tax return outstanding. SARS can charge the fixed amount penalty for non-compliance. Now, obviously that would apply to somebody who is required to submit a tax return. If you're not required to submit a tax return, then you can't be charged a penalty for non-submission. So if you charged a penalty and you are in fact not required to submit a tax return, then you would submit the request for remission, and your reason for remission would be on the basis not liable, because you're not liable for the penalty if you're not liable to submit a tax return. Okay, hope that assists you there. Right, any other questions? Otherwise, I'll hand back to Stan in the meantime. Danny, right, okay, so I'll hand back to you. And if there are any other questions that come through, we can deal with them. Thank you.
All this time you thought we were sleeping, but it's not true.
I did. I'm sure I could be sleeping.
That's fascinating stuff. I'm intrigued with this, but SARS's input into everybody's lives. Jackie, thanks so much for all this. It was a fascinating talk as usual. I look forward to next year. And I mean, SARS is keeping you in business. Keep changing all the rules and regulations. If they had to stop, you'd have nothing to do.
Yeah, that's for sure. It certainly does keep us on our toes, doesn't it? I know everyone, my family who are, well, apart from Mark, who's a CA, but I mean, none of the rest of my family really knows a lot about tax. They can't understand what keeps me going all the time with all these tax changes. They don't believe
Exactly.
that there can be
What's
so
the
many
problem?
time. Yeah.
Thanks to everybody for attending. Hope you enjoyed as much as we did. Your certificates will be on their way soon. And there's one more seminar this year, a webinar with Edwin Selps. Going to talk about ethics, which I think everybody needs their CPD points. So your notice will be going out the next day or so. So please sign up. And Jackie, once again, thanks very much. Jenny, thank you.
Thank you.
Everybody can go and have an early tea. Thank you very much.
Great. Thanks.
We lost standing.
And enjoy the
I
rest.
see another question.
No,
If anyone wants to actually speak their question instead of typing it out, they can just raise their hand in the question box. But I see everyone's starting to log out. But if anyone last minute wants to quickly ask something, just put up your hand. I can open up your permission to talk if you need.
Sure.
Give it a couple of minutes and let's see. Otherwise, we'll lock those up for the day.
Yep.
Just one question about the time of these assessments. When a taxpayer submits an assessment, a revised assessment. So you've had your assessment, you don't agree, you submit an edited one. How long has the receiver got to, or the SARS people got to respond? Is it unlimited or?
Well, yeah, I mean, it's not specifically prescribed, but obviously, you know, if you have submitted your information, they should reply within the timeframes that they have sort of committed to in terms of their, what's that document that they issued? Yeah, I forget, the name escapes me now, but it's not specifically prescribed, Stan. It just needs to be a reasonable period of time, yeah.
Because the first one was submitted to somebody else that submitted a return. The first one, they made a mistake and they issued a revised one. The first one they assessed within a couple of days. But then it's taken like nearly 6 weeks now, nothing's happened. So does that sound reasonable?
No, there's not a prescribed period of time. I mean, you know, even people who submit their tax returns and maybe they're claiming additional medical credit, or, you know, the big thing at the moment, this home office expenses, they are going to find
that's what the fly in the ointment was.
Yeah. It's taking a lot longer for those assessments to be issued. Yeah.
I have one person who wants to speak. Let me allow him in.
Sure.
Okay, Neil, you are in if you need to say anything. You just muted, so just unmute yourself and you're allowed to, you can speak if you need to.
Okay, sorry, I've just unmuted. We're fascinated with your medals, Jackie.
Oh my goodness! It's amazing what people notice in the background. Hey, yeah.
It's all awards from SARS. It's awards from SARS.
Are they all from SARS, or are you running marathons?
Well, no. They're actually, you know what? They're actually not mine. I'm using the room that my son used to occupy, and I'm waiting for him to take all his medals away. But you know what happens when your children move out, they never seem to take all their stuff with them. So it's actually all.
We've just got one moving in again.
So it's all my son's old swimming medals and so on. So even the reason for me to tell him that he needs to take them out now. Yeah.
Thank you.
Okay.
Yeah, just for your edification, between Bruce Fordyce, Anna and Rob and myself, we won 14 comrades.
Oh, goodness.
No, I don't believe that. When did you first run, Stan?
Well, you said between you and Bruce, right? So, yeah.
Between me, Bruce, and Rob, we've run 114. One's 1-9, one's 1-5, and me, well.
So you're talking to somebody who's done that fun run a few times, so watch out.
Oh, boy.
I also done it.
Yeah.
Well done, Stan.
Thanks. Okay, thank you.
Thank you. No, take it. There's no other questions.
It was worse doing tax, anything to do with tax than running.
Yeah. Okay. All right. Well, thanks everybody, and
Thank you.
have a nice restful break over December. Good luck for the rest of the filing season, and hopefully chat to you again next year.
Cheers. Bye.
Cheers, everyone.
Did you get the next one?